Hello, I'm David Chaston with 90 at 9, brought to you by interest.co.nz. This week at Everything You Need to Know in 90 seconds at 9 o'clock, including news regulators are about to practice for a financial meltdown. But first, as we start the new week, the story is the bond rally and the worries about the impacts of low inflation. At the end of trading in New York last week, the US Treasury 10-year bonds yielded just 2.29%. In fact, the US Treasury 30-year is about to go under 3%. Our swap rates will come under pressure today when they open. The US Treasury inflation-protected securities market is suggesting price stagnation may be just around the corner. Not only is American inflation not rising, the yields investors are prepared to offer above that have virtually disappeared, and the move lower in the past 10 days has been fast. Driving the lower inflation outlook is the combination of low oil prices, lower prices for many key commodities, especially metals, and the high US dollar. Taken together, they are allowing consumer price inflation to stay very low in key economies, and the talking heads are talking more about the prospect of deflation. Deflation is feared because that makes the value of money higher, which in turn means you will be able to buy more with it the longer you wait and accumulate it, which means you may not spend it now, so demand could fall along with industrial output and jobs. Whether this is true or not is not really being debated, however. Those extremely low TIPS yields are seeing investors pull large sums from the funds that invest in them. Funds like PIMCO are seeing major withdrawal flows. That creates bond market stability risk. To guard against such risk, regulators in the United States and Britain will get together in a war room tomorrow to see if they can cope with any possible fallout when the next big bank or other major financial institution topples over. In China, their top central bank economist has warned that their sluggish real estate sector is the biggest risk to the country's economy, although he dismissed any risk of a hard landing. A marked slowdown in property investment has hit their steel sector. That represents a major flow-on risk for Australia. The S&P 500 and Nasdaq on Friday posted their largest weekly decline since May 2012, and the Dow turned negative for the year, led down by technology stocks after a chipmaker warned of a major pullback in the industry. The oil price has also fallen again and is now under $86 a barrel, with the Brent price now under $90 a barrel. The surging US dollar has a lot to do with this movement. Gold was down on Friday to $1,221 an ounce. We start the week with our currency level higher than it was at this time last week. The New Zealand dollar is at 78.1 US cents. We're back over 90 Aussie cents, and the TWI is at 76.3. I'm David Chaston. That was 90 at 9, brought to you by interest.co.nz.